Today my guest is Jonathan McGuire. He's with the real estate team at Aldrich Advisors, based in Salem, Oregon, and they have offices up and down the West Coast. Jonathan is a returning guest, and today we're going to talk with Jonathan about qualified opportunity zones and the revisions that have happened since the last time we spoke with him over a year ago. But first, a quick reminder, if you like the show, please let us know. You can do this. You can like, share, and comment, and also subscribe. And also, if you want to see how handsome our guests are, be sure to check out our YouTube channel at Commercial Real Estate Pro Network on YouTube. With that, I want to welcome back my guest, Jonathan McGuire. Jonathan, welcome to CREPN Radio.
Thank you for having me back. I love being able to talk with you and let people know about what's going on in the tax world of real estate. So,
well, and I can assure you this: the listeners that I've had the opportunity to talk with, and just the people in general about opportunity zones and stuff, it is a topic that has a lot of buzz. But I think there's also an equal amount of misunderstanding, or more misunderstanding than there is actual understanding. And my hope is that today we can kind of go through what we thought it was when it first came out, and then kind of compare and contrast with what the revisions provide for. And but before we jump into this, if you could take just a second and just again share with the listeners a little bit about your background.
Yeah. So I've been at Aldrich for about 5 years now, and what I do here is I work exclusively with real estate developers, investors, and then the service industries that come together to help the real estate industry. So whether that be brokers, dealers, independent, like mortgage brokers, whoever. I'll even work with other attorneys and even other accountants, just because at the end of the day we got to take care of everybody. But with my areas of expertise, it's focused around real estate. Probably the two things that I'm providing the biggest bang for the buck on are dealing with the repair regulations, which that was a prior conversation we had a couple years ago, and those impacts of how to capitalize or depreciate something. But then also, just over this past year, absorbing these opportunity zones, setting up opportunity funds, and all that goes into structuring these and making sure they're compliant with the IRS regulations. Those have been, that's basically been my last 8 months. I've been drinking out of a fire hose, just because at the end of the day, there's not a lot of CPAs out there that have fully taken the time to absorb these and figure out the intricate details of how they work. And so that's one thing that I've tried to do, is try to be at the top of my game. I guarantee you there's somebody else out there that knows more than me, but I dare you to go find them, because they're few and far between. So,
Right. Well, in just the information and how kind of unique it is in perspective to historical tax code, tax law, and then kind of what I'm gathering from even our conversation. Because when was it? The tax code was passed in 16. Was that right? December 16 or December 17?
December 17.
Okay, so we've basically just been through the first tax season of the implications of the tax code, right? Mm-hmm. And also recently, what's it been, 6 weeks now that the revisions were, I don't know if are they revisions, or were they basically a statement of understanding, or how do you characterize?
So what they are Treasury regulations. So at the end of the day, the IRS is part of the Department of Treasury, and so the Congress says when they pass bills or whatever, hey, Treasury, you go write the regulations, how all this stuff is going to work. We're just going to give you the basic framework. You go interpret the rules and make them work. So what these are the second round of proposed regulations. So what these proposed regulations are basically, this is a draft, but they're a draft that can be relied upon. And so right now we're in a point of where the IRS is waiting for public comment. They'll eventually have hearings on the second round of proposed regulations, and someday in the future they will issue finalized regulations, which are then clean cut, this is the law of the land. They carry about as much weight as the tax code itself. It's not quite at the level, but I mean, there's nothing else pretty much more authoritative than the regulations themselves.
Got it. But is it fair to assume that as we work through that process from the law to the regulations that we're getting more clarity and that things are, you're not going to have some wild strand pop out of this thing like, no, that's not what we meant. You're kind of narrowing the...
Yeah, and with the second round of regulations, they closed a lot of the big picture items that we needed to fill out our loose ends on. That there's still going to be those little detail things that pop up and catches a couple people off guard, but overall we have the basic mechanical framework now from inception to exit of the opportunity zone investment. The last time we talked, we just had a kind of a good idea of how the setup was going to work. It wasn't until October of last year that we had the first round of regulations, which solidified where we were going in terms of setup and operations. And the the second round gave us tied up some loose ends and then answered our exit strategy, which was a huge deal because that changed the ball game based upon how the tax code was written. So.
Got it. Well, I'm wondering, would it be okay if we started with what we thought we knew, or should we just jump into what is? Because I'm thinking,
let's go through kind of where you think we are, and
okay,
and then I can fill in the holes on the back end.
Okay, so the whole idea was to stimulate investment. The concept. If we start with the concept was to stimulate investment. And from that, the question was, where can we get the money to invest? And so they said, hey, what if we gave those citizens, those people that are invested in anything, and it was not exclusive to real estate. It could be stocks, whatever it was. But if you had a capital gain, right, you could take that capital gain and you could then invest in an opportunity, a qualified opportunity zone fund, and then the benefit for doing that was if you stayed in, and this is where I want to make sure you keep me on track, is if you stayed in for 5 years, and correct me if I'm wrong, you would get a 10% discount on the owed tax. And I say owed tax. What's the correct word? Because there's also a step up in basis, or is it what's the lingo?
So the way it works is you're going to start off with a temporary gain deferral, and that temporary gain deferral is of any capital gain realized and reinvested into an opportunity fund, and that gain deferral lasts until December 31st of 2026. So that's kind of the line in the sand of, as of this date, any tax that I'm deferring will become due.
Okay.
Then if you complete 5 years, or if you've held the investment for 5 years prior to the end of 2026, you're going to get a 10% discount in that deferred gain. So $100 a gain is now $90 of gain. So you're saving 10 cents on the dollar there in tax, whatever your tax rate is on those gains. And then furthermore, if you meet a 7-year hold period of that investment prior to the end of 2026, you will get a additional 5%, so that 90 becomes 85. So you can have up to a 15% tax savings on these deferred gains. The challenge is to get that 7-year, you have to be invested by the end of 2019.
Yeah, so time's ticking. This is the year if you want that 15% discount, right?
Yes.
Okay.
And at the end of the day, that's just the small little cherry on top.
Right. I don't want to get ahead of myself. So but the important date in all of this is December 31, 2026, correct? That is the end zone. That's it. I mean, if you're
Yes.
so if you don't invest prior to 21, you wouldn't have the chance for that savings per se, or for the discount of the tax owed, or at least the 10% discount. Correct? Yeah. Okay.
Yeah.
Okay. So now the other piece of this, and I think the only thing I want to make sure that I understand clearly, because this is where I've had conversations with people, and I don't want to say it's almost come to blows, but there's been a complete lack of understanding between me and the other party, and I just want to make sure that you set me straight here on this and make sure that I understand it. Mm-hmm. Is that so? I had that original gain. I go invest in the fund. Okay, that original amount. So let's just say I had $100,000 gain. That is going to be taxed. Period.
Correct.
Right? Okay.
Yes.
If I keep it in there 5 years, I can get the 10% discount. If I keep it in there 7 years, I can get a 15% discount, provided I get in, this year. Am I right?
Yes.
Okay. Because the real cherry on top on this whole thing is that the subsequent gain. So if my 100 stays in there and I stay in now for 10 years, right? Anything above and beyond what my basis is tax-free.
Yes.
Am I right?
Yes.
Did I get that right?
Yeah. So if you invested $100,000 today, that $100,000 would be taxed in 2026. But then, in 2030, that is now worth, let's say, $300,000. There's an appreciation of 2,000. 3 minus 1 is 2. That $200,000 is a tax-free gain.
Okay. So I'm tracking with you, and I think that's the point that we really want to make sure that everybody understands is that's the real meat of this thing, right?
Mm-hmm. Yes.
Okay. And then the only other thing that I think, just backing up, and I don't know how critical this is, but because I think this is more of how the opportunity zones came about, is that the states went to their local municipalities or whatever and asked, what do you got? Well, where would you like money to be invested, or what do you need improved? They then submitted that list up to the feds, and that's how these maps and communities or whatever have been identified. Am I right on how the zones were identified?
More or less. They were actually based off of the low-income housing census tracts that they use for the low-income housing credits, and then each governor from the 50 states, and then like Puerto Rico and a couple other territories, were able to submit their selected zones to the U.S. Treasury. The Treasury gave the seal of approval, and they did 2 tranches of issuing where the zones are. They came out in April and June of 2018.
Okay. The only other thing that I think that I understood was that the way it was originally explained to me and what we talked about was that you had to buy something new, something that you did not currently hold, in order, and then you had to substantially improve it or develop the property in order to take advantage of the opportunity zone tax benefits.
Yeah.
Did I get that right? That was the original version, right?
That was my original understanding of it, but especially now with some additional clarifications in the second round of regulations, what they said is you can have used property inside of a zone. It's just its use inside the zone has to originate with the opportunity fund. So, I mean, this is a little bit harder to do for real estate, but let's say, I'm a contractor and I've got a, tractor or whatever, and that I'm purchasing, but I'm setting up this new LLC construction company inside of an opportunity zone. I now can go buy this previously owned tractor, backhoe thing, whatever, to do my construction work, and take that from a non-zone, put it into service inside of a zone, and that would be a qualifying purchase.
Okay.
So there's a little you know, weird thing in the regs where it talks about if you have a abandoned structure that has been abandoned for the last 5 years, where effectively it's, you know, a non-performing asset, even though there's that building is technically used, whether or not it's a tear down or not, I believe there's a provision in the proposed regulations that would allow that to be treated as new use.
Okay.
And so even though you previously owned it, it could be a qualifying asset. Because one of the key things inside of these rules is that the property or the assets utilized in the Opportunity Zone Fund or Opportunity Zone business must be acquired after December 31st of 2017. So anything that was previously owned inside of a zone by some entity, it's automatically disqualified by if you're the existing holder of it. You would have to then go purchase this from essentially a third party, because you can't buy it from a related party, because then that's self-dealing. It's going against the spirit of the regulations of the law, and so you have to go buy this from a, you know, bona fide third party and arm's length transaction. And yes, you can have a pre-existing building, but then you can go do the substantial improvement or do a tear down, or if it's raw land, you know, build up. Got
it. And not that this applies so much to real estate investors, but I think the other thing that I don't know if it was fully understood was the businesses within the zone, and maybe that was always implied, but I just didn't. I was focused more on the real estate itself. But now the operators inside that, like you were talking about the tractor, they can take advantage of these. So if I buy a building, improve it, and I go out and find some new tenants, these new tenants can come in and take advantage of these same regulations for their investment in that building. Is that correct?
Yes. So, you know, I think this is a venture capitalist dream, because they can come in, partner with a developer, build a building inside of the zone, and that way they have a stable performing asset there. And then they can go get investment, you know, in X, Y, and Z company, and that they want to bring in, have them be the tenants inside of their building. So you have a vested interest in the performance of your building and in those businesses, because you want to maintain your rent revenue, as well as making sure that those businesses are performing. And so it creates a really cool dynamic relationship between investor, tenant, and landlord. And it gets, I mean, some people might not want to do that, and that's fine, but I see a whole lot of benefit there to, you know, at the end of the day, you know, these venture capitalists, they're looking for that 1 in 20, 1 in 100 deal that when it capitalizes and makes the money, it's going to pay for all 99 other losses and some.
Right.
And so why not also hedge the bet by having a nice piece of real estate that you build or completely renovate that's going to be a dynamic, you know, workspace for these people. That way they can actually go and perform what they want to do. And so even if they grow and leave, you still have something of value, tangible value, that can still be carried on to your next investment that you want to make or bring in.
No, that's I think that's a whole new level of enticement, as opposed to as essentially if you're the landlord, you've got the opportunity, but tenants, or at least it wasn't expressed as such, or I didn't understand it to be that, but that's clearly a huge thing to I guess for everybody to have be on the same page, rowing in the same direction, kind of thing. All right, so we talked about what I understood. Has any of that changed? Based on the timeline, the discounts, and then the subsequent gain, is all that still status quo?
The only thing I will add is to be able to realize that 100% uh, gain exclusion when you sell the investment or the asset, that has to be done by the end of 2047. In the proposed regulations, they wanted to put a into the program at some point in the future. That way, people actually wrap it up, and then once they sell that, that creates another churn of the cash in the economy, and that's, cash turns over 6, 7 times before it stops from one transaction. And so, at the end of the day, that they put that in there just as a way to, hey, we got to wrap this program up at some point.
Sure. Well, but I would guess that that's not really going to concern you too much if you're getting it all tax free.
No. Yeah.
So, whether it's.
Maybe my appreciation in 2057 would have been, insane, and then it would be great. But, at the end of the day, to get a tax-free investment over 30 years, that you can't complain about that.
Yeah.
It's never happened before.
So let me ask you about this, because as I talked to you a little bit before we started, I mentioned to you that I'd been talking with an older investor about this. And, this all sounds really good, but if you're already kind of older and you're kind of looking to put all your affairs in order, and is there still an opportunity per se for them to get the benefit or pass the benefit on? If somebody's, got because understandably the older you are, the more likelihood you have gains or potential gains to invest. Can you speak a little bit to that and how that?
Yeah. So just to set the table for this, the old way of looking at real estate is you're going to 1031 exchange until death, and at that, because then you're never going to pay any capital gains on your property unless you have some boot or some other realization there. But then at the end of the day, you'll have the estate tax that comes into play. Your heirs inherit the property with a stepped up basis. Then they can choose to either dispose of it, or they can hold it and continue on, the family legacy of the real estate investment. So that's the way we've kind of classically done our estate planning for real estate investors primarily. But now with the opportunity zone, in the most recent round of regulations, they've essentially blessed the ability to pass the gain exclusion onto your heirs. I haven't walked through all the particulars of how that would work, because I personally don't do a whole lot of estate planning, but I do have estate planning team members here at Aldrich that I'm able to utilize that specialize in it, just like how I specialize with real estate. We can sit down, I can tell them the real estate rules, they can tell me the estate rules, and then we can come together and put a plan together. And so working through the exact details of that, I don't know for sure yet, but we have the primary rules in there for when I need to actually go do it. I know exactly where to look. So that's just more of a planning thing to have out there in the back of your mind if you wanted to go move forward with it. So
got it. Well, but even that, that answers a lot of questions, or at least it maintains the viability of the qualified opportunity zone for somebody that is older, and thought, well, if you gotta be here till then what's the point? But if that gain transfers or is transferable to your heirs, that's big stuff. Could certainly set up your heirs well.
Yeah.
So essentially we've talked about the genesis of it, the benefits of it, for investing, and the ability for occupiers or not occupiers, tenants to come in and take advantage of this, and then the ability to pass this on. Are there more things that have been clarified, or can you kind of run down a list of things that have been?
Yes. So one of the big questions, so there's these two rules out there talking to, let me back up a little bit. With the opportunity funds, the actual fund that you set up to do the investment, there's a rule inside of that fund that says 90% of my assets that the fund holds must be invested in qualified opportunity zone stock, qualified opportunity zone partnership interests, or qualified opportunity zone property. So what that is a corporation that's set up inside of a zone, a partnership LLC that's set up inside of a zone, or if the fund is going to directly hold qualifying property. And so you have to meet 90% of that. But then going down to that next level, the stock or the LLC that the fund owns, there's a 70% rule that says, if this partnership interest, at least 70% of the property inside of this business must be qualified, meaning it's acquired after 12/31/17. It has original use with the opportunity zone business. So, i.e., if you're doing a building, it's either a new build or you do a substantial improvement. The substantial improvement is the doubling or the doubling of the acquisition cost with your improvements. One thing that we didn't know originally, which came out with the first round of regulations, is they said land is always going to have original use because it is impossible to improve land the way that they want it improved. So we're just going to give land away, which is a very favorable position because now when you're looking at the substantial improvement rules, you're just looking at your building asset. So if you purchase something for $800,000 and based upon the county's on the property tax, the allocation between land and building, you'd have a 40 and a 60% split. Well, 40% of that's land, that's 320. The other 480 is building. Well, instead of doing an $800,000 improvement, I only have to do a $480,000 improvement.
Right.
And that change, that was the biggest substantial change from the original tax code to these first round of regulations, where they blessed the building as just being the thing that needs to be improved. If they wouldn't have done that, it would have been very difficult to get this program off and running from a property standpoint. But business is business. Operating business can do whatever, but that was the biggest thing in all of this to come out was saying land we exclude, we just look at the building asset.
So let me ask you, you mentioned the county assessor's record as far as evaluation. Is that essentially the go-to for determining value?
Yeah, that is the default that you utilize. There's actually some rules somewhere. I've looked it up before. I don't remember where it is in code or rules or whatever, but the IRS says the county assessor is your default to use as your evaluation. If you find that is way off from what market is, then you can go get a qualified appraisal, and then that qualified appraisal, assuming it's done by a professional, should stand in front of an IRS agent or examiner, whoever, if say you were to be audited. And so but the reason why you do that is, historically we're always wanting to pump more into building and less into land because we want our depreciation.
Right. So
with the opportunity zone, you're flipping it around if you have an existing structure because you want to do as little improvement as possible for some people to make this work. And so that's the key.
Sure, but even in that, if you're talking about a building that has been, vacant or whatever, I would think that the argument's fairly easy to corroborate, as far as the, just the value.
Mhm.
But that's still, just to pull the land out of that, that's great.
Yeah, I've just from looking at some of those existing structures out there where there's nobody in them, but the bones, the meat of the building are still good. And I'm like, but just because of where it is, it's substantially depreciated in value. If you just, do the interior TIs and then, get some nice facade changes to the outside, kind of refresh the appearance of the building. I mean, you can do that a lot cheaper than doing a full, $800,000 job versus a 480,000. And so
Does that run a potential challenge if you're going to then do a cost segregation? Or I mean, because I guess the question is, if you're getting the gain tax free, assumably you'd still be trying to get your depreciation, would you not?
Yes. So I actually talked to somebody about this today, and the way I view it is, assuming you're able to absorb your losses with, tax bases or passive activity loss issues that might exist. That's other tax things for another day. But let's just say you can absorb your losses from depreciation and business interest expense and whatever else you have. It still makes sense to do the cost seg study because you're going to accelerate that depreciation on the front end. So if you had a highly, cash flowing business with, creating a lot of income, you want to, defer that operating tax until a later date because that's at ordinary rate. So you're buying yourself some time there. But also, if you're not going to do the full 27 and a half year for multifamily or 39 year for commercial, you want to take advantage of this because, let's say you sell it in 15 years, the mechanics of this is a basis step up
Right.
to the fair market value. Therefore, even though you've taken all this depreciation, you have no depreciation recapture to recognize because you have no gain. So you're trading an ordinary deduction, so up to a 37% tax rate today, in exchange for no tax rate on your gain at the end of the day because you have no taxable gain.
That's huge.
So
that's like
it's a no-brainer.
You're winning all day long.
I know.
That's just, I was just going, wait a minute, because the, from the cost segregation study, that's kind of an operational expense from a standpoint of your year-to-year tax filing, right? But the beauty of this whole thing is at the end when you sell the thing, do you avoid recapture and all that stuff? Is that
mechanically, that's how I see it. I invite somebody to tell me differently, but the way that I see it is that the letter of the law says a basis step up in your asset to the fair market value at the date of sale, which means you have no gain or loss. Because you have no gain or loss, you effectively cannot have any depreciation recapture.
That's just, it's like I'm guessing that anybody listening to this right now is just going, holy moly, because that's huge to be able to, one, you're starting with your basis for your asset is lower because you've pulled out the land. Mm-hmm. And now you're able to then meet the requirement by substantially improving. So whatever that is, you double that, what's left over. Mm-hmm. And then you are able to then cost segregate, accelerate the depreciation. And then, provided you stay in this thing 10 plus years, whatever gain is, adios, sayonara.
Mm-hmm. Yeah, that's, whether that's intended or not, I love it. And then on top of that too, let's say you want to do a let's say in year 10 you got to replace the roof. Well, then you could go back, to the repair regs, do a partial asset disposition of your old roof, so you get to dispose of that at a discounted rate or however your CPA decides to do it, and then capitalize the new one. Yeah, you got to restart depreciation, but you just wrote off that entire roof from your original acquisition. I mean, and then I don't have any depreciation recapture on the back end for that either. That's huge. You're getting this off the books there as well. So there's some benefits.
No. Let me ask you, because when and I don't remember if it was after we started talking or recording or before, but you had mentioned some of the clarifications were really in the disposition. Seeing this thing go full cycle, because everything that we've talked about so far is kind of on the front end, with the exception of this, what we've started talking about, the upon sale and cost segregation and that. You acquire the property, you do the improvements, you operate it, you hold on to it for 10 years.
Mm-hmm.
Can you talk about what do we know about the mechanics? What do we know about beyond what we've just talked about? Can you speak to that a little bit?
Yeah. So with the exit strategy, the statute's plain language indicates that you're looking at a sale of the investment. So without any clarification, the conservative talking head would say, it looks like at this point they're just limiting this to the sale of your fund. Well, nobody wants to nobody wants to purchase an LLC interest or a stock interest generally. They want to do asset purchases. With the round 2 of regulations, what they did is they more or less blessed the idea of an asset sale. And this is something that I actually, after the first round of regulations, I was hoping that they would do. And in the corporate tax world, there's this thing called 1202 stock. It's referring to a code section 1202. And what it would do is allow the sale of a small corporation to exclude up to $10 million of gain from the sale of their stock, assuming it was, or trying to think of the rule. Yeah, it could either be an actual stock sale, because with a stock deal sometimes you got to keep the existing corporation, or you could do an asset sale and then do a deemed liquidation upon the asset sale. And so they kind of borrowed the rules from 1202, where they're talking from the asset sale, where you can dispose of the assets rather than sell the actual interest in the fund. So, if I have Opportunity Zone business that holds property, I can sell the property inside the business, continue the investment in the fund, and take the cash out and recognize no gain on that. So that the allowance for an asset sale makes not only good tax sense but also good business sense, because now you're not just limited to this one particular exit strategy.
So it sounds like within the fund is where this really plays out, because I mean the asset's pretty cut and dry. I mean, you've got an asset, you have it, you sell it, it's gone. The gain from that, but the gain, if it's inside the fund, then are you saying that you could still redeploy that to reinvest that, or what are we saying?
Hypothetically, you could redeploy it, or use it in other existing Opportunity Zone properties that you have. So where I see the benefit of this is, let's say you have a $500 million fund invested in 10 different investments. You can sell one investment in year 1, year 10, another investment in year 11, 12, 13, and you can continue the existence of the fund until everything is fully liquidated.
Okay.
And so that's that was a huge deal because I was like, well, now we have to stage, an asset sale of everything at once, and it gets messy. And I was
Right.
like, no, if you meet the 10 years, we're going to bless whatever gain is flowing through to you as qualifying.
Got it. Yeah, because otherwise you'd be setting up a fund for every, or I guess like you said, an LLC. I guess you could
Hmm.
do it that way too, but
Yeah.
it seems like it is makes sense. So you'd mentioned something in the qualifications that the 90% of the funds had to be invested in the
Hmm.
uh, uh, the, the QO fund or the QOZ, I guess.
Yeah.
Um, so if I'm assuming they would pay out those, they would disperse those to their participants because you'd be past the hurdle of any kind of a penalty tax, right? I mean, there'd be no
Hmm.
reason to continue to hold them.
Yeah. Because at the end of the day, cash is pretty much deemed a non-qualifying asset. There is the ability to retain cash, which we can actually go into that next. But upon a liquidation event of a property, uh, there's no reason to retain that cash because hypothetically you're not going to be making any more opportunity zone investments,
Right,
and
right,
so it's at that point in time it's just time to liquidate. Everybody goes their own way, and you can go into whatever you want to do next.
right. Um, you mentioned the retaining cash. You want to talk
Mhm.
about that? And that's
Yes.
within. We're talking about within the fund, right?
Yeah, within the fund as well as the actual operating business.
Okay.
So what there is there's what one of the things is there's that 180-day requirement to have the fund invest in one of these properties. So either in stock, in a partnership interest, or directly in property. But then let's say you buy some land and you got to go build it. Well, or you're doing a substantial improvement. Well, there's no way I'm getting a building done or doing a huge substantial remodel in 6 months. Maybe on the size of building, more likely than not, it's not going to happen. So what they did in the first round of regulations was give you what's called a working capital safe harbor. And what that working capital safe harbor is if you have cash coming into a fund and then is going to be used for the development of a piece of property, you can hold and retain that cash for up to 30 months. And that 30-month time frame is at the end of it, you must have expended all that cash into the project that you were going into. And there's some little detailed rules behind that, but that's not appropriate for this. But what they the one of the biggest questions was well, what if I'm building a $300 million office tower in downtown Portland? That's going to take more than 2.5 years, and it's probably going to take me 2.5 years just to get the permitting done because it's Portland. Um, what what they did is in the second round of regulations, they said, there will be a stoppage or a pause of that 30-month clock if everything else is done except you were delayed by government action, i.e., you're waiting for a permit, you're waiting for an EPA study or some other sort of weird thing out there just in your development process. And so, I mean, this doesn't put a stoppage time when you're doing your due diligence, but through anything that is being dealt with the government. So they allow that. So how you quantify that and where your stoppage time is, it's probably just going to be upon the date of when the application goes in, and then you're just waiting on the clock until, here's, day one of year two, and I'm like, hey, I finally got information that they're 6 months away from giving me my permit. And so once you have that permit or whatever you need in place, that 30-month clock starts from where it left off. And so, I mean, you hypothetically could hold on to this cash for 5 years and then finally at the end of year 5, you've expended all the cash because you had your permitting done. Um, Kind of a tax strategy here is, well, with that cash that you're going to have, most people are going to go get a 30/70 loan to value ratio with the bank or whoever's doing the lending on this. I mean, you could do more equity, you could do less. It's all dependent upon how you want to do it, but there's no tracing of the dollars that you're using. So if I put in, $100 into this fund, and I'm going to need $300 to do the development from a lender, I'm going to spend that $100 on my land acquisition, on my soft costs, on my due diligence, architects, whatever, before I actually use, my construction loan to build up or do my renovation. And so if you're bumping up against the clock somewhere, that's a strategy to employ. There's also been a talk too of, well, maybe I, prepay contractors. Maybe not a good idea, but I mean, it depends who you're working with and how reputable they are. But at least you can minimize your impact of having to deal with this working capital requirement.
But the 30-month timeline, I mean, what? Because you mentioned a construction loan. Once you've got your money in, and the construction financing's taken over for, I mean, once you've closed the loan and stuff, are you good to go? I mean, even if it takes longer to build the project?
Yeah.
Or? Okay.
Yeah. The only thing where there's a timeline on the project is if you're doing a substantial improvement. If you're doing a substantial improvement, there is also a 30-month rule from acquisition. You must complete the improvement within 30 months.
Okay.
If you're doing a new build, basically an unlimited time.
Okay, so on the improvements, on a renovation, you've got 30 months.
Yeah.
Okay.
And that makes logical sense to me because, I mean, yeah, you could have some really substantial renovations that take a long time, but the bones of your structure are still there. I mean, short of a tear down, I mean, if you're doing a tear down, that's a new build.
Right.
From a tax perspective, that's a new build. But I mean, if you're gutting it and the bones are staying there, that should still go a lot faster than a new build will, just because of all the other stuff of connecting utilities and services and whatever else. I mean, there's a whole lot more land development, I would say, that would go into the new build than with a reno.
Gotcha. Anything else that's substantially more clear than where we started?
Yeah, I've got two other things here that are pretty significant. The first is with Section 1231 gain. So what that is gain that you would have realized from the sale of, investment, real estate, or assets that you've used in a trade or business. So Section 1231 gain is a capital gain, and so it can be rolled into a fund. The thing is, though, this is the first, kind of bad thing per se that came out of the regulations. This is out of round 2, is they're requiring that you net your 1231 gains and losses throughout the year, and you don't actually get to utilize those for deferral until the end of the tax year. So why that complicates things is, let's say, today's, it's the end of May, early June. Let's say we recognize a gain today. I can't reinvest that gain until 12/31 of 2019 because I have to net it with any potential gains or losses out there. So effectively, 12/31 gains aren't taxed until the end of the tax year.
Okay, but we're speaking about equipment, are we not? Or from the operation? Are we talking about
equipment or building?
Oh, really?
So or land used in a business or investment.
Okay, so if I do sell a building today, I can't reinvest that until 1/1 of 20 essentially, because we've
Yeah.
got to true up and find out if we have any other gains or losses to account.
Yeah. And and
But
and where that
this is segregated in a fund already, is it not? Are we talking?
no
Okay.
no this is gain that you would be realizing, from, let's say I've got, ABC LLC that owns, $1 million building. I sell it and recognize a $500,000 gain. But then I have XYZ LLC over here where I'm getting a, $300,000 loss. I this could happen January 1. This could happen December 30th. I have to wait until December 31st to net those gains together inside of whoever the taxable owner is of that, to be able to defer the gain.
So even if I sell a property today and
Mhm.
I've got a gain, I cannot invest it into a fund until 1/1 after the year
You,
ends.
you could do it on 12/31 of 19,
Okay.
but
But the point being is that I can't today race down the street or find, a fund manager I know that's got a fund and
mhm.
put it in there until.
Yeah.
Oh, that's kind of weird.
Yeah, and I get why they did that, because you otherwise there's no way there's some other things with Section 1231 gains and losses, especially when you get to your individual return, where if you had net losses in a prior year, because 1231 losses are taxed as ordinary income, 1231 gains are taxed as capital gains income. So what happens is there's a 5-year look back on your 1231 losses, and if you have gains in a future year, you have to recapture those losses, and so those 1231 gains become ordinary instead of capital. And so this was to accommodate that existing rule on the books, because they want you to net those gains out.
They want you to keep carrying those losses forward, right?
Yeah.
They want to get rid
Yeah.
of those. I gotcha.
Yeah,
Okay.
so it
So
makes sense from a tax perspective, but it sucks.
so if one had little or no losses carrying forward
Mhm.
from a prior year, would that still prohibit them from investing until 12/31?
It technically would, because you have to wait
All right.
until you have an accounting of everything that happened in the year to be able to do that.
All right. Well, that's kind of a joy kill or buzz kill there from. I mean, I guess it's not necessarily. I mean, from a standpoint of, I guess you need to plan and understand,
Mhm.
where you're going. That makes sense. But interesting way to get into that.
Yeah. And another interesting thing, a caveat off of that is you're going to need to do some tax planning to think through where should I recognize these 1231 gains, and where should I do my opportunity zone investment. So if I know me as a individual on my 1040, I'm going to have gains and losses from 1231 assets coming through. Well, I want to maximize the amount of gain that I can defer. So rather than have me, the individual, be the person doing the deferment, why not have the entity above me that I'm invested in turn into the opportunity zone fund investor? Because any entity or any taxable entity or person can go invest in an opportunity fund. So maybe it makes sense to say, hey, in this one entity over here, I have $1 million gain. This other one, I have $1 million loss. Do I want to, recognize no gain or loss at my individual level? Or, maybe I receive $1 million loss, and then my $1 million gains deferred up above in this other entity that I hold an interest in. And then those tax benefits would effectively pass through to you as the individual once you got the K1 from that partnership at the end of the year. So there's some tax planning ideas to think through there. Again, you don't know what's going to happen with your partnership, like if the other partners want to do this or not. But
Sure, but I guess question if you do invest through the entity,
Mm-hmm.
I guess if they come through tax free, then do they get dispersed tax free too?
Can you repeat that?
So if you have a fund, let's just say you, Jonathan,
Mm-hmm.
have an entity, okay,
Mm-hmm.
and it's McGuire LLC, all right,
Mm-hmm.
and so you invest in McGuire through McGuire LLC. You liquidate the property, and it's in McGuire LLC, tax free because you've had it for 10 years, right?
Yes.
Then
Okay.
does it get paid out to you, Jonathan, through K1 tax free?
Yes. So that would pass through because at the end of the day, the fund would have no gain or loss. Therefore, McGuire LLC would have no gain or loss. Therefore,
Jonathan would.
McGuire me would not have any gain or loss.
I don't think that's where you were going. It was a thought that occurred in my head when with what you were talking.
Okay.
And so I don't want to, but you were talking about tax planning, in that, and I apologize because it made me think that way. Can you go back? Because maybe I think I derailed us just for a little bit there.
Okay.
So you were talking about tax planning, and we're talking about making certain of, or we're talking about any entity can do this, and that's, and I think we may have been talking. I don't know if we were tied more towards the getting in or the getting out, because where my mind went to was the getting out. That's where I came from.
I was looking more at the getting in
Okay.
of being able to maximize the investment that you were going to put into the fund.
Okay.
So if we had that $1 million gain and the $1 million loss, then I have no capital gains to invest today.
Right.
I'm stuck.
Right.
Whereas here I could defer up here, take the loss. In 2026, they'd kick out that $1 million gain, maybe discounted, but at least I got a deferral up here in a new investment, and I'm able to take advantage of the tax-free benefits on the back end. And so there's that. It would probably help if I could draw it out, but a podcast doesn't really do a service there on that. But
No, I got you. And just for the listeners, Jonathan has talked about, and I'm going to try and get him to do this. He's talked about a white paper, so if we'll try and get the white paper and provide that for you. Jonathan, is there anything else on this that some highlights, things that we should?
Yeah, just I'll quickly go through them.
Okay.
First thing is cash out debt financing. So what the IRS has said is that you can pretty much have a liquidity event in the form of a cash out refi, where you then, let's say 5, 6, 7, 8 years down the road, hey, just in time for when my tax bill comes due at the end of 2026, you can take a distribution from, debt financing that you generate at 2026, 2027, and use that to pay your tax. So there's a ability to get cash out on the already partially appreciated investment. And so not if it's in a closely held fund, it'd probably be easier to put that in your operating agreement to be able to make that happen. If you're in a big conglomerate or big, $500 million fund, a little bit harder to do because then you're having to appease, probably 100 plus different members in your fund, and that's not practical. But it's a tool in the tool bag should you choose to use it. Another thing which was also interesting is previously it was thought that you had to only invest cash into an opportunity fund. Now they say that they really don't care about the cash. They just care that you have assets of value that mirror or match that gain that you're trying to defer. So if I have, a raw piece of land sitting over here that is unproductive or whatever, I then can contribute that into the fund to satisfy my gain. And assuming you don't run afoul of some of the qualifying property rules, a property acquisition or contribution to the fund in lieu of cash can work. The same thing could go for any personal property. So your equipment, your furniture, fixtures, whatever that may be, that is something that now you could potentially contribute. And that helps with some planning issues there for some people that aren't necessarily liquid.
Yeah, the contribution there, does that run up against any of that challenge of the year-end, the 1231 we've been talking about? Or is it just that if I've got a plot of land in a fund or in a zone, could I contribute that to the builder or whoever that comes to me and approaches and participate, or is that?
Yeah. As long as you have capital gains, you can contribute your land that you're holding, and that be your contribution to the overall fund.
So I do have to have gains somewhere, but I don't have to necessarily contribute those gains. I have to have gains, period.
Yeah.
Okay.
And even if you don't have gains, you can still contribute the land and be able to participate in the investment. It's just you're not going to have the opportunity zone benefits. But maybe you have a piece of land that you haven't been able to get off the ground, but now you can because with the opportunity zone it pencils or whatever, then, hey, Mr. Sweat Equity, Mr. Contractor, and money people with the investors, hey, I've got this piece of land. What do you want to do with it? I've held it. I'll take 10% and you guys do the rest. I mean, that opens up that possibility.
So you said you wouldn't necessarily be able to, even if you didn't have gains, you wouldn't necessarily benefit from the qualified opportunity zone, the 10-year hold thing. But it seems like if you had any kind of a gain, period. I mean, even if I, took something for something and got a gain for something, that would be of benefit, significant benefit, I would think.
Yeah, and I mean, if you have, a non-retirement stock portfolio, just, a trading account or whatever, maybe you've got some Apple or Amazon stock or something that's, gone up in value over the past 5-10 years. Maybe you want to lock in those gains. Well, here's an opportunity there to maybe sell, reinvest that cash, and then use that land, that piece of land that you have to satisfy that capital gain.
Got it.
So there's that's another tax planning benefit there, but it's dealing with the qualifying property acquisitions and what have you. There's some hoops to jump through there to make it work, but it is possible.
Okay. Any others you want to highlight? You there?
Those are probably the biggest things for. Yeah. I lost you for a second.
Yeah, no, I just faded there for a second.
Yeah, that's probably the biggest thing. The biggest things from a real estate perspective. I'm sure we missed a few things, but and there's some other items that are more directly related to operating businesses, but we'll forgo that today. So.
Got it. Okay, before we wrap up, Jonathan, I've been asking all of my guests if they could take a look at what they consider the biggest risk. And this kind of stems from, by day I'm an insurance broker and we deal in risk management. And risk management, we essentially, there's three strategies we employ on a regular basis. One is you can avoid the risk. Two is you can minimize the risk. Or three, you can transfer the risk. And that's essentially what an insurance policy is, right?
Mhm.
And so I've been asking all of my guests if they could identify what they see is the biggest risk. And,
Mhm.
I'm not necessarily looking for something that's an insurance-related risk, but I wanted to ask you, what is the biggest risk you see that investors face?
Mhm. I would say the biggest risk is not taking a serious look at opportunity zones. If you don't do it and put a little bit of sweat equity into this to see if you can make a deal fit inside of a zone, if you have a project underway or a potential project that you're looking at, I mean, you would be doing yourself a disservice if you have property or a business that it's going to be located in the zone and not take advantage of this. Now, maybe you don't have capital gains, so you can't do anything, but maybe you need some investors it and you need capital. Why take a debt interest? Let's get somebody with equity that wants to have a vested interest in seeing the business succeed and create an investment that works for them and for you, and then it's a win-win on both sides. That
No,
so.
no, that's great. Just in even the way you frame that with the debt versus the equity kind of thing, and they have the opportunity to really take advantage of that. Uh,
Mhm.
that's great. Jonathan, where can the listeners go to find out more and connect with you?
Yeah, you can go to Aldrich's website, which is www.aldrich, that's Aldrich, advisors.com. There you can, read about all the services we provide. We're primarily, we were birthed as a CPA firm, but we also do wealth advising, benefit advising, retirement plan solutions. We also can do outsource IT consulting. That's a new service that we've just started here in the last couple months from an acquisition that we went through. But and then on there, you can search for opportunity zones. My name will pop up. You'll see me as the person. And in there, there's ways there that you can contact me just in a quick direct message that will come straight to my email. Or if you want to email me, you can go. My email is jmcguire, JMCGUIRE, at aldrichadvisors.com. And then other contact information is there on the website for phone or whatever. So,
Got it. Well, Jonathan, I have learned a lot, and I really appreciate you taking the time to clarify this because I got to call the guy I was talking to earlier and tell him how he was wrong. And but no, in all honesty, I think there's a ton of what people think this is all about, and to actually have a conversation and to clarify it is really necessary in order to truly take advantage of it. And I appreciate you taking the time to do it.
yeah, my pleasure.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.